Please, Manish Sonthalia of Motilal Oswal Asset Management now joins us from the sidelines of the Motilal Oswal 11th Investor Conference. Manish, hi, good morning. Good to have you on the show. I was in the conference yesterday, and there was a bit of a dichotomy there because we have seen so much FI selling, and I believe that in your conference you have seen actually record FI turnout. So, tell us what's happening right now. What's the investor mood? And do you think, personally, do you think we are set to see lower levels from here on?
Well, the mood is a bit somber. That's a correct assessment of how clients are reacting. But to say the least, corporates don't seem to be sounding that bearish. We have had key bankers talking yesterday. We had the coal secretary talking yesterday. We had Ms. Chanda Kochar talking, Mr. Rana Kapoor talking. I mean, the corporates don't seem to be as negative as what the environment is being made out to be. Of course, because of the correction that we have seen in the markets, the mood is a bit somber. But I think fund managers are seasoned. They have seen this sort of corrections in the past as well. So nothing comes as a big surprise to anybody. And quite a few of them are actually looking at this correction as an opportunity to pile on to their stocks, which they have always liked.
Okay. Manish, hi, good to see you in. I just wanted to bring up a point that Lata had mentioned in the morning, that retail investors would start getting a little wary when we start seeing them actually stop SIPs or reduce the SIP amounts that they have. Is that already happening, or if it's not already tangible at this point, are more queries coming in?
The problem is with the trader community. It is the people who deal with the futures and options segment of the market, who wants to leverage on their little capital to get rich very quickly. They are the guys who are suffering. To put it on record, we have seen record inflows into our funds, and our funds are basically comprising of retail HNI money. Even as the FIs are actually selling, we are looking at a situation where, the domestic individuals who have actually seen the rally miss out, till about the correction when it began, are looking at it as an opportunity to get into the markets, because the good quality stocks are available at a slight discount to what the prices were 1 month ago, one and a half months ago, and it's a good opportunity. So there's absolutely a stark difference between how an investor, whether it be the retail or the HNI investor, is thinking, and how a retail and a HNI trader is thinking. There is tremendous fear.
Manish, that point is Manish, that point is taken, Manish. I think what Ekta was referring to, and even Lata earlier in the morning, are we at risk of that changing? Because see, I mean, when you reach a stage where even your 1 year NAVs start to turn negative, when your 2 year NAVs start to turn negative, which is happening now, then there is a risk of seeing a bit of a stop of some of these SIPs or mutual fund purchases. So is there a risk of that taking place? The domestic flows drying up a bit?
You have been in the markets as long as I have been. We have seen the markets for the last 15, 20 years. We all know that there is no gain without pain. It's not that human beings are wired to time markets to perfection, that you will try and get in at the lowest and you will try and get out at the highest levels. That is not doable. What we can broadly say is that India is falling in line with other global and Asian markets. Is it the Asian crisis again, revisited? I don't think so. Are the valuations getting corrected for your good quality stocks? The answer is affirmative yes. And, we have seen that whenever people have actually participated, when there is blood on the street, there is comfort when the markets, show some sign of rationality. So we are traversing at the extremes. I'm not saying today may be the bottom or tomorrow may be the bottom. We may fall another 500 points on the Nifty. Who knows? But this fall will be in line with other global markets. India is not falling in isolation. Okay, so that's a point that needs to be kept into mind. one should look at this as an opportunity rather than as an opportunity to exit.
Okay, well, the visuals have some real high stalwarts in the meeting right now. We had some conversation which in fact took place with Jayant Sinha speaking and the chief economic advisor as well. We'll keep getting you those visuals through the day. We have IC Deveshwar also, who's a part of it, and other people such as Mukesh Ambani and Sunil Mittal as well. So you can see all of India Inc. present in that one room. But Manish, if you had to point out one trigger for the markets to bounce back from current levels and to get that conviction back, what would it be?
Get over with the Fed rate hike sooner or later, and we will be done with the uncertainty. You know, we all know that China is slowing down. Its problems are not going to go away in a hurry. But at the end of the day, if you have a twin problem or twin apprehensions on the Fed hike as well as the China slowdown, you know, the bigger problem to get out of the way is the Fed rate hike. If we are to be done with in September, let's get over with it, and the whole markets would resemble some sort of rationality somewhere down the line.
Okay, but Manish, pharma has taken a big hit over the last 3 or 4 days. That's one area which has hurt a lot of people because there was quite a bit of safe haven buying that had taken place at the start of this correction. What's your call on some of these names like Lupin, Dr. Reddy's, Sun Pharma, or even the mid caps or the non-index large caps like Aurobindo Pharma, Glenmark, Divi's Labs, where we've seen quite a bit of correction?
Some degree of froth was definitely there in some of the pharma names. So we in our portfolio have Sun Pharma, which resembles the largest pharmaceutical company available at the least elevated prices to earning numbers. On the other hand, we have had corrections seen in IPCA that we have it in our mid-cap portfolio. But I agree with the fact that there was definite amount of froth in some of the mid-cap pharma names, and they are seeing some sort of corrections. But so be it. And now the valuations have corrected. Some of the good quality names can be looked into.
In terms of sectoral allocation, then what does it stand at right now, Manish, for you?
So we are completely avoiding the commodity pack as a whole. Private capex, infra, balance sheets in this space are quite stretched. So even government spending is not going to improve the situation for a lot of infra companies per se. So our favorite spaces continue to remain as a consumer, the export opportunity, which is IT and pharma, private sector banks, and selectively Make in India theme and some of the oil marketing companies. That's about it.
Okay, Manish, 2 or 3 stocks that really led to the big outperformance for your portfolio were, the big auto names, Maruti and Eicher Motors. Even they have started to correct now quite significantly. Would you be topping up some of these names, or would you be tempted to take some money off some of these stocks now?
No, I am not actually trimming any allocation in any of the auto names. I don't have Maruti in my PMS fund. I do have Eicher Motors, and if a 19,000 or 20,000 rupee stock has got corrected to 17,000 rupee stock, it has become more attractive because I am relatively more sure about the growth opportunities which this company has for the next 3, 4, 5 years. One should be aware about what one is doing. So if growth comes at a slightly elevated price and that sees some degree of correction, I don't think the conviction gets waived off. So I continue to remain fully allocated to Eicher Motors and will continue to do so in the future as well.
Okay. Manish, just wanted your view on the FII flow picture. Do you think that once the band-aid is yanked out from the US, i.e. the Fed does raise interest rates, the volatility would settle, something that you alluded to earlier, and hence FII flows will possibly come back convincingly into the Indian markets? Because if you compare us to an EM basket, we're much better on most macro parameters, including growth as well as the rupee right now.
Absolutely. If you have some degree of uncertainty on a few factors, and if that be taken out, sooner or later you'll have markets pricing in most part of it earlier than what the decision came. Like if the Fed was to hike rates on 17th of September, markets in their progress have actually factored in some portion of it. So once it gets out the way, you have the markets pricing in the event, and we'll get to a normalcy. You know, whether it's 500 points lower from here or 500 points higher from there, only time will tell. But you'll get that event out, and that's how markets function. So India is definitely in a better place as far as the forex side is concerned, or the macroeconomics is concerned. You know, as compared to the Asian counterparts or companies which have foreign debt to GDP as much higher levels than what India has. We are roughly around 23-24%, and that's much lower than most of the commodity-driven economies. You know, so they will be more vulnerable as opposed to India. So we would tend to outperform even the Asian counterparts, and even currencies should find some level of support somewhere around these levels.
Okay. Fair enough, Manish. We leave it on that note. Thank you very much for joining in and speaking to us. So that's the word coming in.